Thursday, the 4th of April. Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson, alongside Kriti Gupta. Equity trading less than an hour away. So what do you need to know this Thursday morning? Powell pushing markets higher, sticking to the dovish script. US payroll data tomorrow, the next big event for investors. Commodities also continue to climb. Gold setting yet another record high. Brent is pushing towards $90 a barrel, and NATO celebrates its 75th anniversary, highlighting in so many ways the tough spending decisions that Europe must now face as it looks to rearm. Kriti.
In the meantime, a quick check on these markets here, which from a futures perspective, not doing a whole lot. A lot of eyes, of course, on the bond market. What Chair Powell's comments mean yesterday for the European story. 436 on the 10-year. We are inching higher and higher, passing that 430 level. Gold is the one that's catching our eye, though. Another record for the precious metal. We're going to dive into it. Markets today starts right now.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Jay Powell speaking at Stanford yesterday. You may have heard that before. I certainly feel like I felt that I'd heard that before, Kriti. He stuck to the script. There was nothing new here.
Yeah.
Yet, after a couple of days when actually there's been this wobble around the idea that actually the Fed may only go 2 rather than 3 in terms of the cuts this year, Powell kind of calmed everybody down a little bit on that.
He calmed everyone down. Raphael Bostic dug in his heels as well. It's those Fed speakers.
Again.
Yeah. Well, one cut from someone who has historically been quite the dove on the FOMC committee, really kind of saying almost the exact same thing that Loretta Mester and Mary Daly said, but with a different end result, which I thought was interesting. You had the major hawk there, Michelle Bowman, as well, speaking, not really giving indication on rate cuts, talking more about the discount window and the way that the Fed's accessing it. We're talking a lot about what the rate cut aspect means for the broader markets. I think something that may be on the Fed's mind is in this kind of new era of post-pandemic, post-GFC, what does normal actually mean in terms of the way the Fed and the banking system actually operates? And there's a lot of big picture questions that are kind of going unanswered here.
There are, but I appreciate what you're saying about the banking story and the discount window and how that operates. But the bigger picture here continues to be, what is the Fed going to do? And it continues to be a coin toss.
Yeah.
And that's the amazing thing. Here we are this close potentially to the first cut in June. June doesn't feel very far away right now, and it's still a coin toss.
Yeah. I think what's interesting about Chair Powell is that even though it did sound very deja vu, he really stuck to the script there. The one thing that I thought was maybe noticeable, maybe I'm reading too much into this, was that he did actually kind of acknowledge that these last couple of months may be concerning. And he kind of just said, we're not kind of writing it off as transitory or temporary.
It's not a bump. We don't know if it's a bump yet.
That's his wording. And that to me implies that there might be a little kind of speckle of concern there in terms of some sort of reacceleration.
He does not want to be Burns. He does not want that reacceleration of inflation to become a problem for him in the way that it did for Burns back in the 70s that Volcker ultimately had to end up fixing. He still doesn't want that to be hanging around his neck. He's got one eye clearly on the election. He's got a lot of kind of balls in the air right now trying to figure out what exactly he's going to be doing next. But it feels like a really difficult sort of story at the moment. It feels easier for the European central banks. I think the Fed complicates the world for them, but I think it feels easier. We're now into the run into the ECB next week. It's going to be really interesting to see what the ECB Lagarde has to say next week. But before that, we've got to get through claims today, which I think is going to be interesting. I think there's a lot of options positioning, particularly around euro-dollar. And then I think you've also got to get through, clearly, that payroll number tomorrow, the big number that everybody's watching out for.
Yeah.
And the headline number is going to be interesting, but the unemployment number is going to be fascinating.
It is. You know, speaking of the data, the one piece of data that I think the markets didn't really take in stride here was the ISM services number that we got yesterday. The estimate was 58, came out at like 53. Big drop just after the
prices
major
paid
reaction.
Was where the real kind of story was there as well.
Which was similar to ISM manufacturing numbers on Monday as well. I think the concern here, though, is that the markets didn't really care. They didn't really bat an eye when the data actually dropped. All eyes were on Powell. Powell didn't say anything, and it was like, all right, well, more of the same.
That's interesting. I thought you did see a bit of a move.
Okay.
And you did see a reaction to that, because that was a really interesting piece of data, I thought, because a lot of people dismiss the ISM. You want to be watching kind of some of the more kind of headline numbers, but I think ISM is interesting because this is service sector. And I think the prices paid component drop in the service sector I thought was fascinating. And there's evidence as well of some productivity coming through as well, which I think is interesting too.
Yeah.
This takes us back to a story you've been kind of referencing quite a lot, and that's what's happening with immigration and what's happening with the workforce kind of participation story. I think all of that's really interesting. And I think the ISM story yesterday was actually quite interesting. We're going to have an opportunity to
dive
talk
into the nerdy.
Well, yeah, I think if you want to talk to anybody about what is happening here, Andrew Bulls is probably the perfect person. He's the global CIO of fixed income over at Pimco. You want to figure out what's going on, he's probably a good place to start. They've got an interesting trade on, which is basically the Fed's going to be more cautious than the rest of the world.
Yeah.
And that kind of relative trade story is going to be really where the action's going to be, particularly in the fixed income story. So that's going to be, that'll be kind of maybe where we start with him, but I think we've got a lot to talk about.
We have a lot to talk about, and for him, when you kind of just read past comments and past interviews that he's done, he really focuses on the long end of the bond market, doesn't he?
Yep.
Which is interesting because we're talking about ISM manufacturing, ISM services, seeing a little bit more focus this week than we traditionally do, I think, relative to other pieces of data like CPI, PCE, et cetera. Those traditionally have more of a relationship and correlation to the long end of the curve. So does the immigration story. So does policy. So does fiscal deficit concerns.
Yep.
That is really all a long end story. So I'm curious to see how he's thinking about that.
Let me throw something else into that pot as well, which is what is happening with the tariff story.
Yeah.
Janet Yellen out overnight. She's on her way to China now. She's going to be there for a couple of days. I think the first meeting is Friday into Saturday, but she's going to be arriving, I think, a little later on today. As she departed, it'll gaggle as you would normally anticipate with reporters, making it very clear that she felt that actually, particularly in areas like green energy, the Chinese are maybe pushing products out onto the world that are being manufactured at uneconomic rates. I'm not going to use the word dumping here, but she's kind of taking us in that direction. And maybe she is going to take a tougher line than maybe Biden did in that Xi conversation when it comes to this tariff story. We know that the US is getting ready potentially to deliver the latest review on tariffs. Is she hinting at maybe a tougher stance?
At the same time, and you flagged this yesterday, actually, is the devaluation story, the currency story, and what that means then for inflows into treasuries as well, specifically because she's the Treasury Secretary and the former chair of the Fed. She has kind of a unique insight into that as well. I'm curious, though, from a markets perspective and from a financial audience perspective, why this is seeing such a focus now. Is it just because Yellen is making this trip, which she has made before? Several other kind of U.S. delegations have made that trip before, and yet the market seems super tuned into what tariffs mean, what immigration means. These are issues that have been boiling over for a while. Why now such the focus?
Well, I think, A, a focus on inflation. B, you've got the election coming up, which I think is kind of sharpening everybody's pencils around this issue.
Sure, but it's like...
Yeah, no, I appreciate it's November, but we all know that we're already into the run into that.
Yeah.
So I think it is interesting. And I think there's also a bit of muscle memory. We all remember what happened with Trump when this China tariff story became such a big focus. And I think the currency story is definitely part of that. We'll see ultimately what we get Friday. How tough a line is she really prepared to take? She's been at the more dovish end historically when it comes to China.
She has, and perhaps, I mean, you kind of talked about taking a tougher stance than Biden. What if she takes a softer stance in that when it comes to things like Huawei and TikTok, Biden really saying we don't want to discourage, the investment coming in from China. We don't want to outright sell TikTok. We want to simply kind of have a divestiture, I think, or what was the exact phrasing. But this is interesting because it comes amid, yes, tariffs, but also this tech story, the reciprocity risk there. At a time when we're talking about TikTok, when we're talking about productivity as well, you talked about in the labor market and those kind of numbers, AI plays a role in all of that.
So AI, I think, is fascinating. There's two real kind of corporate stories, particularly out of the States, that stand out. So what stand out to me this morning, and you've kind of taken us there. Apple, the story is that Apple wants to focus on robots. Done the car, don't want to do the car. We're going to focus on robots right now, which is interesting because NVIDIA, do you remember NVIDIA?
That rings a bell.
Yeah, precisely. That speech that was delivered by Jensen Huang recently with the robots. Robots clearly are going to be hot. But Apple needs AI right now. If you want to get their share price moving, and it is trading at kind of flirting with some key levels right now, Apple needs to deliver something on AI. And then that takes you to the Alphabet story, the FT story this morning, talking about that maybe Apple's going to put some of its AI behind a paywall. And I think, Alphabet's going to put it behind the paywall, which that worrying. They're clearly struggling to monetize.
They are, and I think what's interesting, so twofold. One is the Apple robot story. You didn't actually see a reaction on Amazon. They had that iRobot acquisition that was met with so much kind of pressure from the European side. I believe that deal has gone through now, but it's interesting that Amazon shares didn't really react to that news at all. You would think there would be some sort of trade-off or some sort of like relationship. No, nothing batted an eye. Apple's interesting with the AI story because, to your point, they have that kind of investment or potential partnership that I think Bloomberg has reported with Deep Search. DeepMind, that's the one. But at the same time, bringing it back to the labor conversation, there is a talent war at play here. I believe one of the DeepMind founders was recruited by, I want to say Microsoft is the right one. At the same time, you've got Tesla increasing their pay, saying, we want to hold on to our AI engineers. We don't want to lose them in this kind of talent war, so we're going to pay top dollar. I think there's a lot of questions at the moment of competing, yes, on the technology, but who's leading that charge?
It's musical chairs. But this takes me back to the Alphabet story. Everybody's spending loads of money right now. Spending loads of money on talent, spending loads of money on NVIDIA chips, spending loads of money full stop. The Alphabet story is a concern because what it maybe flags is that these companies are going to struggle to make money off that investment. How do they make money off that investment without cannibalizing their existing business? Can they make money off this business full stop? And if they can't, because this is the next piece in the puzzle, right? So you invest all this money, then that produces some sort of fabulous return further down the road. And NVIDIA's being driven by everybody. Google spending epic amounts of money at the moment. They have to now make money off it. And if they don't, the Magnificent Seven is going to look significantly less magnificent very quickly. Yeah,
and I think one of the kind of concerns as well is you talk about how do you monetize it, how do you make more money on it. What if it's a question of how do you just not lose customers? Because if you have a better product, say, hypothetically, you've got ChatGPT and Bing, Microsoft's Bing, for example, ends up using it. How do you not make that your default searcher? And I think perhaps it's like the losing customers piece that incentivizes holding on to that business rather than monetizing it.
There's a whole load of startups that are coming through as well that could do search really well. Anyway, we're going to be speaking to the OpenAI COO. It's got one of the coolest names out there, actually. This is an exclusive conversation coming up a little later on today. Bragg Lightcap is going to be joining Bloomberg Television, 4:30 p.m. London time. So we're very much looking out for that conversation. What's his take on all of this?
And, of course, OpenAI really expanding their reach as well in terms of the kind of products that they can offer on, I want to say, Sam Altman 2.0, the regime, after, of course, just the leadership changes there. That's going to be something we're watching out very, very closely. Right here in Europe, though, we've got plenty of data to keep our eye on. At 9 a.m. UK time, Euro area services PMI, that final data is going to be released. Does that move the dial at all for the ECB? Does that move the dial at all for the currency picture as well? Meanwhile, just as soon as 1:30 p.m., we start to see some of the U.S. data come out. U.S. trade balances, jobless claims as well. Guys talking a lot about that labor market. All of that is going to be on the minds of not only investors, but also those Fed speakers as well. Let me give you a laundry list of the speakers that we are going to hear from. We've got Harker, Barkin, Goolsbee, Mester, and Kashkari. Remember, Kashkari is not a voting member, but still interesting given that he has that still a very hawkish mentality on the Federal Reserve. Again, how much of that Fed speak really focuses in on that divergence we're seeing at the FOMC. And then, of course, a focus on geopolitics and what's going on in NATO. Those meetings, the second day of them happening today. Also, the alliance marking their 75th anniversary. The geopolitical story is one that we also haven't been discussing that much in context of what it means for the read-through for the economic data as well.
I think NATO, the 75th anniversary of NATO is a really important milestone, not for the historical context, for what it tells you about where Europe is right now. Europe spent the peace dividend post the Cold War. I remember when the Cold War came down, there was a lot of people talking about the fact that NATO doesn't have a purpose going forward. Now, that purpose was rediscovered, but it's been underfunded. And Europe now faces some really difficult questions, I think. Is it weapons or welfare? The welfare, we spent the peace dividend on welfare. Can we continue to do that here in Europe? Can we continue to fund the rearmament program in the way that we would like and deliver the green transition in the way that we would like as well? Europe, I think, has got some really difficult budgetary questions that it needs to answer on the fiscal side. And I think the 75th anniversary of NATO is just a really great moment to think about how we are going to solve that problem.
It is. And I think there's an economic read-through here as well, in that, on the one hand, we're talking about, yes, the deficit concerns and how do you fund this out of need, I guess, is the answer if you start to see the funding dissipate from the United States. But the other part of it is how do you view the actual funding story? And stick with me here. If you look at the way that the United States, you're forced. I'm tying you down to the chair.
Anyway.
But the United States, when historically they've funded defense spending or funded, wars. I mean, I'm going to go all the way back to, say, World War II, for example. It's been a massive boon to the economy. You've seen this kind of reacceleration, right, time and time again. Europe needs to view it that way in terms of expanding capacity, in terms of investing in European defense names, in particular, being able to catch up. And right now, it doesn't feel like the narrative around that spending is.
Well, this is the big conversation. People talk about European exceptionalism. Mohamed El-Erian is talking about it all the time. Is that just funded by a fiscal deficit? Is that the biggest peacetime fiscal deficit we've ever seen in the United States? Is that really just the story? But the US also feels like it's investing in capacity right now, the supply side of the economy, and that maybe is the benefit that it's going to see further down the road. We'll talk about that certainly with Andrew Balls. He's coming up. We're looking forward to this conversation very shortly. Pimco very much positioned for policy divergence, talking about the idea that maybe the Fed is likely to deliver fewer cuts than other major central banks. So you're going to get this divergence. So Andrew Balls, Global CIO of Fixed Income from Pimco, is going to be joining us in the next hour. We're going to get more on the NATO alliance as well, marking its 75th anniversary. We are going to be speaking to Fabrice Pothier, who serves as the head of policy planning for 2 successive NATO Secretary Generals. That interview, 8:45 a.m. UK time. You want to join in this? There's lots to talk about this morning. We want to hear from you. IB Plus TV Go is the function. This is Bloomberg.
The idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now. If you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
The CIO over at T. Rowe Price speaking to Bloomberg Surveillance yesterday, talking about what the risk factor might actually be. Let's bring in a real expert on what the FX read-through is. Jane Foley joins us this morning, the head of FX strategy over at Rabobank. Let's start there. If the Fed makes a mistake, whatever that looks like, what does the dollar do?
Well, I mean, if the Fed makes a mistake, I suppose the mistake would be that they cut interest rates too early and then inflation rises. Now, that's quite interesting because, if you go into 2025, if we, for instance, had a Trump government, you would potentially be looking at more tariffs. You could be looking at more tariffs under Biden government as well. But, we should mention that too. But, more tariffs is probably going to be inflationary for the U.S. economy. Things would go up in price because of the tariffs. And that would suggest that the Fed won't be able to cut interest rates that much. I mean, we're already having that debate now because of the resilience of the U.S. economy. But if there was a more inflationary impulse because of tariffs, well, that really does extend into next year. So you would be looking at quite a narrow easing cycle, or quite a shallow easing cycle for the Federal Reserve potentially into next year. In fact, we think it could be over by the middle of next year. And that suggests the possibility of a sort of a stronger for longer US dollar.
Why? Why? Because at the moment it feels like the correlation is there, but not that strong between what the Fed does and what happens with the dollar. Would that correlation tighten up?
Well, the dollar is still the best performing G10 currency in the year to date.
Yep.
And that, of course, is correlated with the fact that the market has pulled back on its expectations about the amount of interest rate cuts that we could have this year. So the market at the beginning of the year was going for, 6, 7 even, interest rate, 5, 6 interest rate cuts. Now we're down to about 2 and a bit, and nearly 3. And the dollar has strengthened in response to that. But, I agree. There has been a certain amount of resilience. Certainly if you look at euro-dollar, even though the dollar has gained this year, there is, various pushbacks from the euro. The market reluctant, perhaps, to really want to see the dollar keep on ploughing up against the euro. But, the market right now is convinced fairly that the ECB will be cutting interest rates in June, far less so about the Federal Reserve. The Eurozone economy is far weaker. If we look at Germany by itself, it's stuck in, this stagnationary rut. And I would say that assuming that inflation can be kept in check in the Eurozone, and of course we have seen it come down quite significantly. We're now just, 2.4%, something like that. Well, actually, given that we need structural reform in Germany, given that, cheap energy from Russia isn't coming back, that actually a period of relative euro weakness could be quite welcomed by many German industrialists. So I think we're going to go through this period of the next few years when euro-dollar remains far lower than most market valuations.
Japan is not welcoming a cheap currency right now. Do you think, how far does it go? Like, what are the extremes here? Do you think the Japanese are going to have to do something about it? Kind of, where are we? It's nice to have a cheaper currency if you want to do an export boom. The Chinese are looking at that as well. Kind of, where would be too far for the Europeans?
You know, well, where would be too far? And again, this comes back to the pace. But, you know, if inflation can be stabilised at 2.4%, 2.1%, 2.5%, 2%, around about these sorts of levels, i.e., you know, below 3%, then if we were holding, you know, euro-dollar, say, between 104 and 112 for the next 18 months, I think that would be OK, assuming that inflation was in check, because you've got to remember that, you know, the growth expectation for Europe is still fairly lacklustre. So, you know, but this, again, assumes that we're pivoting away, or we can pivot away from, you know, the focus on inflation towards, well, actually, maybe we need to focus a bit more on growth at this point.
Does this take us back to our dollar earners?
It might, yeah. Yesterday. That's actually a very good point. We were talking specifically about how kind of European companies might be the case for them is simply because they have all this kind of U.S. dependency, and that really is a currency story at its core. Talk to us about positioning here, because I'm confused. If there's such a clear case for euro weakness, and the dollar is the best performing G10 currency, and the market is still positioned long dollar, why is the market not seeing this early?
Well, I mean, if you look at the CFTC speculators data, the market's far less long dollar than it was at the start of March. It's, you know, a lot of those positions have been cleared out. You know, but there are other, you know, I've been talking specifically about Germany. I think we need to bring Italy into this. And the market...
Our favorite topic.
You know, the market really has been perhaps ignoring the deterioration in the budget in Italy and actually celebrating the fact that the far-right government hasn't been, or, you know, as worrying as it could have been. So, for instance, you know, it's still pro-Euro, still pro-Ukraine, for instance.
It's been spending lots of money to make sure all of this happens.
Well, you know, this is the problem. The market has just been subtly ignoring the fact that the budget has deteriorated. And instead, the market's been, you know, buying BTPs. That spread has really come in relative to bunds, you know, celebrating the fact that the Italian government hasn't done anything that would really put it on a collision course with Brussels. But the budget position will demand further attention as we move towards the end of this year into next year. It is a worsened budget position. But for now, I think perhaps the better than expected Italy story is partly behind, you know, the resilience of the relative resilience of the euro.
Well, very quickly, I'm going to ask a controversial question. Does the budget even matter if the country itself is, to your point, outperforming?
Today, no. Next year, probably yes, because I think the budget position, you know, will be more in view next year, particularly, you know, if growth begins to stumble. So I think the market has been ignoring it for now, but I don't think that can carry on forever.
Jane, great to see you. Thanks for stopping by to see us this Thursday morning. Jane Foley, Head of FX Strategy at Rabobank. We've been talking about this. You've had this huge spending by the Maloney government. It's been on all kinds of things, but it's also kind of one of the big focuses has been on house renovations.
Yeah.
And that's really driven this budget deficit. And as Jane was saying, BTPs have come in significantly. Yeah. You see that blow out? That could change the narrative very quickly.
I'm going to Italy next week. I'm going to do some on-the-ground reporting for the show.
By on-the-ground reporting, what do you mean?
You know, taste testing, shopping, contributing to the European economy, the Italian economy, helping Giorgia Meloni out.
And then there's the Spanish economy after that.
Yes, and the Spanish economy.
We wonder why we're seeing outperformance.
I'm doing my part for Europe. It's my duty.
Talking of American help for Europe, we're going to be talking about NATO next. Foreign ministers meeting as the alliance celebrates its 75th anniversary, highlighting some big questions, some difficult questions that Europe has to answer when it comes to its spending priorities. We'll talk more about that next. This is Bloomberg.
Welcome back to Markets Today. We're at 30 minutes away from the start of today's trading. Futures not doing a whole lot at the moment. Perhaps a bit of caution. The bond market is really the one that we're focusing on here, coming off the comments of the Federal Reserve, coming off the developments that we are hearing, even in terms of data in the Eurozone, fiscal developments, corporate developments. Feels like the bond market is going to be a little bit juicier than the stock market at the moment. But geopolitics, of course, top of mind on top of all of that. NATO foreign ministers are meeting in Brussels today as the alliance marks its 75th anniversary. Secretary General Jens Stoltenberg will be speaking later this morning at 9 a.m. UK time. Here's what he had to say when it came to support for Ukraine.
We are transforming NATO's comprehensive assistance package into a multi-year program of assistance. We are helping Ukraine move closer to NATO standards on everything from procurement or logistics. And we are supporting Ukraine's reform efforts to bring Ukraine ever closer to the alliance.
Natalia Drozdiak, a reporter in Brussels, joins us this morning. Natalia, it's a pretty big momentous, a momentous occasion for NATO here's 75th anniversary. At the same time, this $100 billion proposal for Ukraine, what does that mean in terms of actually coordinating weapons deliveries?
Yeah, so this plan that NATO is putting forward, which still needs to be discussed among allies and agreed, is really geared at making aid for Ukraine more sustainable over the long term amid political uncertainty, especially with U.S. elections coming up. But in terms of coordinating the weapons deliveries, it is a major step for NATO because that would involve NATO taking a more active role in the war than it has in the past. And it's always sought to distance itself from allies' bilateral aid, in particular to avoid feeding Putin's theories and avoid any sort of escalation between NATO and Russia. On the $100 billion plan, there's still a lot of questions about, how viable this is and how much fresh money will actually enter into that, with some ministers warning about over-promising to Ukraine. But in general, there's a lot of support about trying to figure out ways to make aid for Ukraine more sustainable over the long term.
One of the critical factors behind all of this, of course, Natalia, is how united NATO is. We've seen new members joining, but nevertheless, there are significant splits over key areas of policy going forward from here. Are we going to see some of that evidence, do you think, during this meeting, that division?
Well, they always like to project a united front, especially in light of the war in Ukraine. But as you know, there are 32 allies now, with Finland and Sweden recently joining. So that means, many more member states that they have to coordinate with. But I would say in general, they're still facing challenges both internally and externally. They're grappling with a lot of uncertainty from the U.S. and its commitment to European security, given Trump potentially entering the White House, but also the U.S. for a while now shifting focus to Asia and China. And then I would say externally, they're trying to manage this war in Ukraine, but also manage different conflicts in the Middle East and elsewhere at the same time.
Natalia, thank you very much indeed for joining us. Natalia Drozdiak joining us from Brussels during this NATO meeting. We've got some great coverage coming up for you. Don't miss our conversation a little later with Fabrice Pothier, CEO of Rasmussen Global, on NATO and European defence. He used to be part of the machine. He worked very closely with a number of NATO Secretary Generals. He's got a really great view on what is happening within the organisation. That conversation, 8:30 a.m. London time. And a little bit later on as well this week, we're going to be hearing from NATO Secretary General Jens Stoltenberg. He's going to be joining the surveillance team for a live interview tomorrow. They've all got a lot to discuss, haven't they? Ukraine, Trump presidency, who's going to succeed Stoltenberg, and how Europe actually ends up paying for the rearmament programme that ultimately it feels it needs to go through right now. That interview tomorrow, 12:30 p.m. UK time. Kriti, the challenges are enormous, but the challenges have been enormous basically since the Cold War ended. Europe's been trying to figure out its own security arrangements. It's not really kind of progressed beyond NATO. NATO feels like the correct architecture, but how do you fund it properly? There's so many challenges, but they've existed for such a long time. And it feels like the Ukrainian war has crystallised that, but we still don't have the answers to the questions that the Ukraine war has asked.
The Ukrainian war There's also the question of, and I keep bringing this up, what's going on in the South China Sea and the Indo-Pacific. This has kind of entered the narrative for NATO in a way that I don't think we've ever really talked about before. And I think this is where the succession story really matters here. The Dutch Prime Minister expected to be the front runner in terms of succession for Jens Stoltenberg. That's not a clear case yet. It does have the American backing. There seems to be a clear read-through from Dutch officials into NATO. I think the senior most military officer used to be the head of the Dutch Navy, for example. I wonder how much of that changes the leadership, the read-through, the stance.
Well, with specific reference to Asia. So NATO's been looking for a purpose ever since the Cold War kind of ended. It's been trying to figure that out. Like North Atlantic kind of tells you a story of the fact that it's meant to be kind of centered around Europe. And it's always felt like the US has felt that it's not necessarily the right security architecture for the Asian theatre. The Middle East may be a different question. That feels like it may be with Turkey on the southern flank, maybe a different argument around that. But the big question still remains. That's great. Yeah, you figured out what your purpose is. You figured out what the objective is here. Now you've got to figure out how you're going to fund it, how you're going to staff it, what kit do you need, how you're going to resource that kit. So many questions that NATO still hasn't figured out the answer to. And the spending hole is absolutely enormous.
The spending hole, and then if you do secure the financing, I say this over and over again, do you even have the capacity
to build it,
to manufacture that fast, and what the timeline of that looks like? And I'm curious when we speak to our guest later this hour, or later next hour, excuse me, what that timeline actually looks like. Because if we're talking about years, well, is the war in Ukraine going to last years? I don't know the answer to that question.
Does the Russian threat last years, I think, is the bigger question there in terms of kind of how Europe is maybe positioning itself. But is it a choice? And we've been talking about this over the last few weeks. Is it a choice between weapons and welfare? Is it a choice between weapons and the green transition? Can Europe figure out a way of funding this, given the new rules that are coming into place? Can it fund it with the deficit rules that exist, with the spending rules that are going to be existing going forward? Does there need to be a carve-out for defence? Does there need to be a carve-out for the green transition? If you end up with all of these carve-outs, kind of where does that leave you? So I think some really difficult questions, and I think the 75th anniversary kind of highlights some of those challenges.
It does, and I think even from an investment perspective, you mentioned the carve-outs. What about integrating defense into, say, hypothetically, the ESG standpoint, for example? That has been a point of contention where defense, to your point, was taken out of a lot of investment portfolios because of its association with wars. Now perhaps brought back in because of its association with humanitarian assistance or fighting against the wars or whatever the connotation is.
Does it stand for security? Increasingly, a lot of people are saying it does.
These are very big questions. On the macro front, we're going to dive into all of them. But coming up on the program, we're going to talk a little bit about the micro story. We're going to get your look at your stocks to watch, including Solvay, the chemical company's ADR surging after David Einhorn says he's betting big on the business. This is Bloomberg.
Since last June, assumed that we'll be hitting $90 by May. So it does seem that it's being brought forward by about a month and will be there by April. But again, that as you absolutely correctly pointed out, the risk is that actually on the way to our price forecast, we will be hitting $100 as well.
I'm looking at a $70 to $95 range. That's a wide range, but that's what we've seen in the market over the last couple of years. We've seen distortions, and as those distortions work out, the market recalibrates and goes down. We had a massive distortion in Suez and in the Red Sea and in flows between Europe and west of Europe through the Suez Canal from the Middle East. That is now adjusting.
JP Morgan's Natasha Canova and, of course, Ed Morse, now of Hartree Partners, on their expectations for the oil price over the coming months. Commodities have got a little bit of momentum right now. Stephen Sapinski joins us now to give us kind of take on what that momentum looks like. Stephen, look, you've seen a lot of commodities in the doldrums for a while now. Suddenly they seem to be roaring back to life in a reasonably coordinated fashion. You've got gold up for one reason, but you've got copper up, you've got oil up. How much momentum is there, and how far can it take oil prices?
Yeah, I mean, I think there are two things happening. I think there are physical supply-demand driven increases for some of this, right? I'm talking to a degree oil. The market is tighter because of OPEC plus cuts. So that's driving things up, and there's a lot more upside than downside there. Same with copper. It's a similar sort of story where there are supply constraints from last year from Panama, as well as out of China, while demand is rising because of some pretty positive manufacturing data out of China and the U.S. But at the same time, you know, and I'm sure you're talking about this every segment, it's also the Fed. I mean, what the Federal Reserve decides has been kind of their shift to policy has been moving other things. I'm talking gold and silver. Gold has been hitting a record every day, and the argument on that side is that when they do begin cuts, when they start to roll back the interest rates, then people will, you know, it's a pretty good bet for gold. So that's why people are sort of piling into that, according to some analysts and some people are saying that. Now, of course, when you're looking also at natural gas, prices have remained resilient there as well. While they're not surging, despite inventories for gas in Europe being at the highest level for this time of year, you're still seeing gas prices above pre-war, above the average before the war. We're basically back at the same level before the war began, but they're still not down to the cheaper prices of the 2010s.
So, Stephen, you gave us a good little roundup of all the commodity story there. For me, I think the oil story is the most interesting, simply because it feels like this pickup in prices kind of came out of nowhere, given some of the geopolitical risks we've already been seeing. Walk us through a little bit more of the nitty-gritty of the oil story. How does the Fed connect to that?
Yeah, I mean, I think one of the interesting things that happened over the last 4 months, and you saw this shift. If you had me on the show at the end of 2023, I think there was a lot of discussion about, you know, we're looking at a pretty frothy 2024. The market will be oversupplied. And that's sort of why OPEC Plus, they saw that coming, and they decided to, you know, put some production cuts in place through the first quarter. They extended that yesterday. They reaffirmed they're extending their production cuts through June. And now the IEA is saying that we're in a deficit. We've switched for the second quarter, and that's kind of all pointing to, these are all sort of physical restraints there. Now, of course, there are some other things happening in the market. Mexico has reduced exports to some refineries. There has been more resilient than expected demand in some places. So those together are showing a pretty bullish, interesting picture for oil, which is why some analysts are saying that $100 Brent is in the cards. We're around $90 right now.
Doesn't feel very far away, does it? Certainly doesn't feel very far away compared with kind of where we were recently. Stephen, talk to me about gold. I'm really struggling with why gold is going higher. I can kind of understand it at one level, but I think there's a lot of questions around it. Are people buying gold because they believe that the Fed is going to cut rates and gold, in theory, should do better in a lower rate environment? That's one argument. Are people buying gold because they think inflation is actually going to be stickier and they want to hedge against it? Are people buying gold because they want to sell treasuries and they're looking for something else to park the money in? There seems to be a number of different reasons. Maybe they're all true at the same time. But what do you think?
Well, I mean, what's interesting is that you would think that in a normal time, if there was an expectation that the Fed were going to act and cut interest rates, you would see bond yields fall. But in fact, because of the tone that we're hearing out of the Fed, those yields have actually been increasing, or if you look at the recent Treasury auctions, been staying pretty steady. And despite that, gold continues to rise. So it's almost like there are two views. You know, there were some people at the beginning of the year who thought that the Fed was going to be much more dovish in their policy. But in fact, the amount of basis points that they could cut this year is probably lower than what a lot were expecting, especially when you listen to what Powell is saying. Because of that, you would expect gold to not be hitting a record every day. In fact, every time that Powell were to open his mouth, you would think that potentially, you know, they would fall. But I think just the expectation, if you're looking at a fundamentals point of view, the expectation that they will roll back these interest rates does mean that, okay, well, we got to park our money somewhere. and maybe we're not going to the stock market. We're going to just go right into gold. That will happen there. There is also the sort of one other theory is if you were to price Bitcoin and gold together, they're actually moving pretty closely together. What does that mean? Is that an inflation hedge? Is that someone trying to figure out a different strategy there? Is it more difficult to find a winning strategy when there's so much uncertainty about what the Fed is going to do and you just wanted to stay somewhere? It's not sure, but I think overall the fact that this is breaking records every day, gold every day is hitting a new record, has quite a few people scratching their heads, and there are a few different scenarios you can kind of explain out of that.
Oh, I love a commodities reporter who walks us through Bitcoin and Treasury auctions. Bloomberg Stephen Topkinski, we thank you so much for walking us through all of that. Guy, at his core of what he was saying was it all comes down to the Federal Reserve, even for the commodity picture.
He's been watching the show, hasn't he?
He's our biggest fan, maybe our only viewer, who knows. I think what's interesting is he's talking about this kind of unexpected demand that's coming from who knows where, is what the theme seems to be. There's a chart that shows something similar. Brings me to my chart that caught my eye. We're looking at a very simple chart. It's financial conditions. But I think history matters here because we are at levels in terms of financial conditions that we saw back in the summer of 2021. What was the narrative there? Reacceleration of the economy, post-pandemic demand, fiscal stimulus. Fiscal stimulus has now run out. It's been a couple years since the pandemic. Why are we seeing that same level of support from credit spreads, the stock market, et cetera?
Stock market side, you talk about the fact that the fiscal stimulus story is running out. There's a huge tail in terms of the spending that's been delivered. It's still rolling out, the fiscal spending in the United States. That story is still manifesting itself in an increasing way, you could argue, in so many areas of the economy. So the effect of that maybe hasn't completely come to a conclusion. So the U.S. is still running big budget deficits. It's still spending hand over fist. And the expectation is that that's going to continue. Yeah, there's a multitude of factors coming here together. But the conclusion from your chart would logically be, why does the Fed need to cut rates at this point when financial conditions are as loose as they are? And as you say, in the past, that signaled a reacceleration of the economy.
Yeah, and I think this is where it gets really tricky, right? Because you're seeing financial conditions, and I think we keep coming back to this idea of when you see that much green on the screen, as I just showed, is that doing some of the work for the Federal Reserve? Is that why? Yeah. Is that the cushion for being able to push these cuts further and further out?
Kathy Mann was talking about this about the Bank of England the other day. She's talking about the fact that she's already seeing the effect of the expectation of lower rates in the economy. The UK has got much sort of faster twitch muscles when it comes to monetary policy effect because of the way the mortgage market works. The US doesn't have that.
Yeah.
And you're already seeing that effect coming through into the economy.
But you know, the one part that all of this doesn't take into account is that long dollar story that Jane Foley was talking about earlier. That's where you start to see real trouble. If people starting to pile in, you see that 105 in 3 months for your dollar. You start piling into the dollar. What does that do to the financial conditions? Is that, we talk about currency worries for Japan, for China. Is there a currency worry for the States?
I don't think there's a currency worry for the States. I think we're back to our currency, your problem.
It's true. Potentially. I don't know.
Where does the buck stop? Alex Steele, if you're watching, that one's for you. Let's talk about some stocks we need to be paying attention to. Joe Easton, over to you.
Morning, guys. So the French company Sanofi has agreed to settle 4,000 lawsuits related to claims that it sold the Zantac heartburn medicine without warning patients that it could potentially cause cancer. Now, Sanofi reiterates that it doesn't see merit to these claims, but says they're settling in order to avoid costly litigation, and they would not comment on the exact amount. However, there are also a number of other cases still outstanding over in Delaware that they haven't actually settled, so we're not sure exactly how much of a positive this would be today. But the longer-term picture, this has been a key weight on the company. It bought Zantac back in 2017. One of the developers of the drug was also GlaxoSmithKline in London. And this drop here on the screen is when these lawsuits came about. We saw massive share price plunges. Sanofi actually had a big drop a few months back following a warning related more to its investment in R&D. But again, this could potentially be a positive for those companies today. Here's the analysts on the screen here. 19 buys, only one sell, so we can see pretty much everyone is positive on that one. But do keep an eye on Sanofi and GSK as well, both of those today. Then we're also looking at chemicals. The famed US hedge funder David Einhorn of Greenlight Capital told a conference over in the US that he has bought a stake in Solvay. This is a long stake, according to the analyst. And this is what happened to the stock, up 14% in terms of the ADRs, the US-listed share. Now, we're going to bring up the quote that he said, because we did like this quote. He said, "We think this boring essential chemicals company will generate attractive risk-adjusted returns for investors." There he is on the screen there, more known for his short bets recently against tech firms like Tesla, perhaps. But this is what this boring chemicals company does. Its main product is in soda ash. This is a chemical that's used to make glass, used in windows, that kind of thing. So, yeah, maybe boring, as he says, but potentially good returns on that one. The rest of them are more in agriculture and also food chemicals. So a bit of a diversified business, but could potentially gain today over in Belgium. Finally, in France, we're looking at Saint-Gobain. The company is back on the M&A hunt. It's buying Canada's Bailey Group for $650 million. Now, this follows the company's recent deal for around $3 billion to buy an Australian company, and the firm said that it would continue doing deals. That was in a recent interview with Bloomberg Television. Now, the company makes frames that are used to build buildings, feeding into what Saint-Gobain does in its core business. Here's what's the stock done over the past year, up around 40% over 1 year. Potentially, this could add to those gains, so keep an eye on Saint-Gobain in Paris today.
Joe, great stuff. Thank you very much indeed. Just before we I want to talk about Thames Water for a second, but I also want to talk about that Einhorn story. We were talking yesterday. If you want to see what's happening in an economy, look at what's happening in the chemical sector.
You did say this yesterday.
Tim Forey often talks about it over at the ISM. He says that's his lead indicator as to what's happening with the economy. If you're looking at the manufacturing sector, look at what's happening with chemicals. If Einhorn is investing into chemicals, pay attention to that story. Thames Water is interesting out of the UK. The British government seems to be pushing back pretty hard on the investors in this private company. Are we going to see ultimately it going bang, I think is the question everybody's asking themselves. Or is that just going to be a problem for the next Labour government, assuming that the polls are correct and we get another Labour government? Just keep an eye on that one. It's going to be an interesting story developing here in the UK. European equity markets, we're not far away from the open. That's next. This is Bloomberg. Morning, folks. Thursday, the 4th of April. A couple of minutes to go until the start of equity trading here in Europe. Looks like you're going to see something of a pop, Kriti. Looks like London's going to outperform the commodity trade. Looks like it's coming through. We'll see what effect that has. Keep an eye on Solvay. I would argue keep an eye on Ferrari as well. Downgrade coming through there. That's been one of the bellwether stocks. So it's interesting to see maybe that momentum maybe. Well, it's kind of Ferrari, LVMH, that kind of luxury trade, high margins, high multiples. Is that beginning to roll over? There you go.
It took you all the way till Thursday to mention the multiples. I've been waiting for this all week because of
never far away.
Just always the tip of your tongue.
Yeah.
I think that's important, though. If we talk about the catch-up trade, is the oil trade the catch-up trade? And
commodities more broadly, or just oil?
Big oil, your Shell, your BPs, the ones that have been, by the way, leading the FTSE 100 to those record highs this week alone. It's been a commodity-driven story.
Yep.
Does that have a bigger effect on the multiples that you're talking about?
Well, these are companies that kick out huge amounts of cash, and that's been the argument for people to have owned them.
Yeah.
It hasn't been they've traded on kind of big discounts to the rest of the wider European market. Is that now going to close? I think is going to be one of the key questions that we watch. Bit of a move in the Swiss franc this morning as well. To keep an eye on that. Swiss inflation coming through much softer than anticipated. Maybe in some ways vindicating that SNB move from Jordan to cut rates. Is that an anomaly, or is that a broader story across Europe?
Yeah, I don't have the answer to that. But I think the euro-dollar story is interesting. The currency read-through into the stock market is one that we've talked about with Jane Foley. We've talked about guests after guest. 108 on euro-dollar. Jane Foley says 105 in just a couple of months. European
equities are about to open. Looks like we're going to see a positive session. We'll get the details of that in just a moment. The expectation is that we are going to see maybe the commodity story outperforming today. We'll watch to see whether or not that is ultimately true. Here we go. FTSE 100, 79.37 was the close, unchanged. Let's just see if we get the pop that we're anticipating. There we go. We turn green right on cue. We'll see how some of these big mining stocks do over the next few hours. We are building building up to the claims data out of the States a little bit later on. But the expectation after a decent run for the miners and the commodity stocks, are we going to see that continuing into today's trade? In terms of where the points are coming through, first thing this morning, ASML, Astra, HSBC all higher this morning. Schneider's looks like it's rising as well. Yeah. Novo, a little bit of softness coming through into Novo, which I think is interesting as well. And the luxury stocks look soft. Ferrari, a little soft this morning. In the red, which appears appropriate.
Do you want to spend a second on Ferrari? Can you explain the downgrade here?
It's had a great run. So this has been one of those kind of stock stories that's had a really good run. This is one of the few companies that has pricing power still left. Yeah. It's like if you think about the Hermes, if you think about Birkin bags, this is the kind of the Birkin bag of the car industry.
Thank you for simplifying that. I didn't know what a Ferrari was.
No. But in terms of
I got you.
That's how you want to position this stock.
Yeah.
So my next question off the back of that is, if it's Ferrari's rolling over, does maybe Hermes roll over as well?
That's actually a fairly good point. Speaking of what's rolling over, let's talk about this commodity sector here, because we were talking about whether it was kind of running out of momentum. And it kind of seems like it is a little bit. If you look at some of the names that are outperforming, you see a similar trade that you've seen the last couple of days, which is rates higher, therefore banks higher. But if you look at the commodity names, Shell is on the back foot today.
Yeah,
BP is on the back foot today. So I think what's interesting is seeing that divergence between the oil names and the banking names, because that's been different from the last two sessions that we've seen this week, despite the fact that rates are a little bit higher, oil's a little bit higher. Something's going on with the big oil story.
So maybe we already had the run, which I think is interesting. But Rio is up this morning. Glencore is up. So the miners are tracking higher.
Yeah.
But you're not getting the same thing in the oil story. There you've got Diageo. Shell is the second. Shell's the biggest points drop now on the FTSE 100.
Yeah.
It's dropping around 2.5 points off the FTSE. So, it's a fair point. We are seeing some of that weakness coming in. And on a day when we see NATO celebrating its 75th anniversary, BAE Systems is also a little soft as well.
I think the trade here, to me, on the surface at least, feels that cyclical's on the back foot today. And I'm not super sure what the fundamental reason is around that. Is this just a cautious trade? Is this just a positioning story, as you point out, that maybe the momentum has just run out?
Yep.
Especially when you're seeing a lot of these healthcare stocks outperform, AstraZeneca, GSK, for example, coming out on top, but still in line with the banks. I can't wrap my head around the fact that banks may trade in line almost with healthcare. That to me seems like
banks are kicking out so much cash at the moment. I think that's the trade. Basically,
like a liquidity
it's a return.
More.
Well, they've got the argument is they're overcapitalized. This started in February, this argument, and it's really run since then. The banks are overcapitalized. They're going to kick out lots of money. They're going to return money to shareholders. How long does that last? I think is the question.
All those fun buybacks and dividends.
Oh yeah.
Yeah. Buzzwords there. Let's talk a little bit about the LVMH story, though, because I think it's interesting that we're seeing heavyweights pull back at a time that I still don't know what's driving that either, because do you see the likes of LVMH, et cetera, trade in line with the likes of ASML as this big cap outperformance, or do you see it more become a Chinese consumer story, a European weakness, even a currency story, arguably?
I think there's a strong argument that says that you've got a catch-up trade that I think is in play at the moment. We've been talking about it over the last couple of days. If you want to play catch-up in Europe, what do you have to own? You have to own LVMH, you have to own Hermes, you have to own ASML. So I think it's going to be really interesting to see how that trade oscillates. It's not going to be a straight line, but I think you kind of want to watch it over a few days, maybe a few weeks. Does Europe play catch-up? And are those core stocks going to be at the core of that trade? And if it is, it feels like it is the catch-up trade rather than anything else.
But the catch-up trade is something that we're talking about with even small caps in the States as well. The idea that the United States is seeing these heavyweights outperform, does it then show up? And then also the question of, does the bond market matter more for the stock market? Now, we keep talking about, is 5% the Achilles heel for the stock market? We're not paying a ton of attention to that read-through or that correlation.
I can't figure out exactly kind of what relationship the equity market has with the bond market at the moment. Is good news bad news, or is bad news good news? Anyway, the story yesterday was driven forward, or was it, by Jay Powell. This is what he had to say in California.
Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Joining us now, Andrew Balls, Pimco's CIO for Global Fixed Income. If you want to talk to anybody about what is happening here, Andrew is probably the best person. Andrew, great to have you on the programme. Thanks for taking the time to join us. What do you think? The market can't decide. It's a coin toss as to whether or not we get a rate cut coming through from Jay Powell and the FOMC in June. Why are we still so close to that potential decision and it being a coin toss? What do you think? Why is the market so undecided? what is giving us the jitters and what is giving us the lack of certainty that we can be convinced that they're going to pull the trigger?
Well, great. It is an interesting time. I think that Chair Powell and the committee have signaled they want to cut interest rates this year. I think the tension is that you had a clear picture the second half of last year of disinflation in the US. And then recently you've had a little bit higher inflation numbers. Now, Chair Powell again yesterday said they think this is a blip, but it will give them pause. And then the second thing I think is that the data in the US on the real side has been coming in stronger. And so again, in terms of the timing of the hikes, combination of stronger data and then somewhat higher inflation recently, it still seems pretty likely that they will go the middle of this year, quite likely in June. And market pricing, I think, looks pretty reasonable. But there's the question of how far they will be able to go, given where the inflation data is. The real economy
so let's talk about that. How far are these mid-cycle cuts, or are these end-of-cycle cuts?
I think that's another good question. I think that you have had a different sort of cycle, the post-COVID period and everything. So looking at the historical playbook is a little bit more difficult than normal. The market is pricing in, fairly modest adjustment. That seems reasonable given the data. So kind of the mid-cycle correction. But going forward, you'll have a balance of risks around that. And I think one of the key things for us at Pimco is to look at the US versus the rest of the world. We think that the inflation picture is somewhat clearer outside of the US. The growth slowdown is much more clear outside of the US, technical recession in the UK, Germany, and so on. And so when we look at this, the market pricing looks pretty reasonable, but the risks seem skewed towards more cuts outside of the US. Further moves getting back towards kind of neutral rates, whereas in the US case there is the clear risk on the inflation side, and maybe it is just modest cuts in the US, a slow cycle and a faster cycle over the next year or two outside the US.
Andrew, it's Kriti in London. Good morning. Put some numbers on that for us here. If we're talking about, to your point, the opportunity being elsewhere, what does that mean for very little volatility in just nominal yields? Give us a range, floor, ceiling for the 10-year.
So I think the US, for US 10 years, it looks about right. Here, 4.5% and higher, it starts to look attractive. We got close to 5% at the end of last year, and that looked like a clear buying opportunity to us. When you look outside the US, again, in the baseline, I think everything looks pretty reasonable, but the risks, the balance of risks, I think is towards outperformance of non-US duration. So again, at Pimco, we think that Australia, Canada, the UK all look quite attractive. Europe looks okay, and there is the potential for widening of spreads, and then more in terms of the front ends of curves, more from the central bank. So we think at the moment it makes sense to tilt a little bit towards non-US duration. But then overall, fixed income looks attractive here. You were talking earlier about uncertainties in the equity market outlook with high quality fixed income. High quality bond funds give you 5, 6, maybe 7% yields. This looks very attractive at a time when there is a lot of uncertainty in the outlook, and the recession risks. Certainly in the near term, recession risks look reduced in the US. But if the Fed is not over time able to cut rates, you start thinking about the slowdown further out in the US as well. So from that point of view, high quality fixed income, I think, looks very attractive here.
You say the slowdown further out in the United States. Andrew, how do you price in the concerns around the U.S. budget? In just 12 months' time, we might have a different president, and the first thing on their docket, January 2025, is dealing with the debt ceiling yet again. How do you price that in right now?
So I think that so you can see where deficits are in the US at a time of basically full employment in the US. So you can see the significant structural deficit in the US, uncertainty around the election. But regardless of who is president, I don't think you're going to see any significant change there. It'll be interesting, of course, the composition of the House and whether it's divided government. But overall, it's hard to see much shift in terms of this structural US deficit. I think from that point of view, it makes sense for us to be in the 5 to 10 year part of the curve in the US and be underweight the longer end of the curve in case fiscal concerns start to weigh on the market. You had a demonstration last summer of the steepening of the curve, the underperformance of the long end of the curve in the US, and I think it's worth being in the 5 to 10 year part because you could see higher term premia in the US. I always think you're not going to get an exciting adjustment like we had in the UK 1 or 2 years ago. The US is a more important reserve currency, very liquid market, but the probability of a higher term premium in the long end is something that's a good idea for active managers to guard against.
Exciting, yeah, that's one way of describing it. Andrew, can I just take you back to the relative trade between the US and maybe Europe? To what extent can treasuries and bunds diverge at this point? How far can they diverge? I'm trying to work out whether or not we end up in a situation where just can European front ends come down, but actually the long end ends up being reasonably anchored by what happens with the treasury market, and you end up with disinverted curves in Europe as a result of kind of rate cuts here, but no rate cuts over in the States?
Yeah, so I think that's a good question again. So I think firstly you can test the ranges we've seen over time. This does look like real US exceptionalism in terms of the strength of the economy versus the rest of the world. I think European trade itself is not the top of our list. Again, Australia, Canada, the UK, I think you have the potential for outperformance in the 5 to 10 year part of the curve. Europe, this could happen as well, but it's not as obvious. But in these other markets, there's probably a better potential for outperformance in terms of 5 to 10 year duration. And then at the front ends of the curves, Australia, really, it's not that much is priced in. The UK, it looks pretty fair, but we would see the balance towards doing more. Similar in Canada, these are markets where they're more interest rate sensitive, which is one key difference versus the US. So I think the best way to approach this is a diversified set of positions favoring non-US duration. This has been working quite well in the last few weeks, and I think this will continue to work until we get a clearer picture in terms of US inflation and the relative path versus the rest of the world.
Andrew, how does credit perform in the scenario that you are laying out? And the tight spreads that we're seeing in credit continue, do you think?
Yeah, it's been interesting because you have seen the market price out a lot of easing led by the US compared with the end of last year, and credit markets, equity markets have performed fine. I think at the baseline that will continue. The real risk case would be if there was a risk of further hikes in the US. I think that's a very low probability. But Chairman Powell's comments yesterday, that there is a risk for the Fed in going too fast, and so he wants to guard against the risk of allowing a kind of a re-inflation process in the US. So from my point of view, if they push out the market pushes out rate cuts further, that's probably consistent with credit markets performing okay. It's a real tail risk, I think, the possibility of the Fed being forced to hike rates further. But you saw 2022 that difficult process of credit markets, equity markets underperforming as we did have the big repricing for Fed expectations in 2022.
Andrew, what are the tail risks that you're watching out for right now? They center around potentially CRE impacting the banking sector, forcing the Fed to take action. As you look at the tails, what do they look like and how significant are they?
I think that when you look at the US economy, if you look at the interest rate sensitive parts of the US economy, you do see real impact. So we had the regional banking problems in the US, and there are clear problems in commercial real estate. So I think the bank loans markets, lower quality credit, more interest rate sensitive borrowers, more sensitive to the economy borrowers. I think you need to be careful there. The good news, I think, is you can remain up in quality, high quality credit, investment grade credit, senior financials, all look attractive. So it makes sense, I think, to be up in quality. Again, the core bond yields are very good, so you don't need to go significantly down in quality. The Fed last year, they did a very good job, I think, in terms of addressing the regional bank problems without allowing this to spread more generally. So that's definitely been a significant positive, but remain up in quality because recession risks reduced, but they have not gone away. And over time, I think it will be likely that you see the impact of tight Fed policy rates if they are forced to remain at relatively tight levels for longer. Then you start to see this more in terms of the broad economic impact. So again, up in quality in credit, I think makes sense.
Eventually, we do get a landing. Andrew, great to catch up. Always appreciate your time. Thank you for spending so much of it with us this morning. Andrew Balls, Pimco's CIO for Global Fixed Income. Thanks very much indeed. We just had some Spanish PMI data, which I'm going to park firmly at the door of Kriti Gupta. Composite PMI rising to 55.3. The forecast there, 54.4. Again, positive data, more positive data from the periphery of Europe rather than the core.
But I'm wondering what flips that, what changes that. I mean, I can appreciate that I'm helping out, can't help out forever, but I think I'm still kind of concerned about this is still an economy that is pushing for rate cuts. It's still an economy where volatility is still in question. What rocks the boat?
Italy, I think it could be the fiscal impulse beginning to fade, which is something to watch out for. Talking of Italy, let's look at Ferrari. Let's look at the core six and figure out what is going on there. Downgrade for Ferrari this morning. Let's see what impact that's having. Not down by that much, actually. It's interesting to see relatively LVMH a little softer this morning. But Schneider good, ASML good. The rest, we're seeing some softness there. What else are we watching this morning? Joe, over to you.
Here's this move in Solvay over in Belgium, up around 6% at the moment, was up around 8% at the open. David Hindhorn, the famed US hedge funder, buying a stake. He says it's boring, but he says that it will give you good returns. They make soda ash, as we said, in stocks to watch, which is used to make glass. So I've had a science lesson this morning. That is one of the best performing stocks we've got today. We don't know how much he's bought, but he has bought a stake, he said yesterday. And we've also bought up IMCD, also in chemicals, a bit of a discounted share placing in this one. A couple of million shares offloaded at a cheap price over in Amsterdam today. Down the bottom here, we've got L'Oreal. They're doing a deal for an Armani fragrance maker, company that sells fragrances for around 400 quid a bottle. They describe themselves as a maker of fragrances for kings. We haven't yet gotten an exact amount on how much that stake is worth, but L'Oreal is buying that company in terms of a stake there, and we're down 0.4% at the moment. We'll wait to get more details on that one. We'll take a look at these big pharma stocks. We did have news of Sanofi settling 4,000 cases related to the Zantac litigation and worries about that causing cancer. Now, there are 20,000 cases still outstanding in a Delaware court, haven't yet been resolved, so we're not seeing a huge move. We're up 0.4%. GlaxoSmithKline pretty much unchanged at the moment. That was one of the developers there. We'll take a look at miners. You've already mentioned the copper price feeding through. Lots of green on the screen in terms of miners today. Focus on the Fed comments yesterday, also on the strong Chinese PMIs. Look at that, pretty much green across the mining sector today. Glencore, Anglo American, a couple of the gainers. In terms of the ratings, as you said, Guy, it's the Birkin bags of the car sector. It's Ferrari. It is downgraded, though, at Barclays, down 0.3%. They only actually went overweight in November, and the stock's up 40% since then. So it is a valuation call on that one. We're slipping a bit today. Then we've got Lloyds. This one more positive in the UK banking space. KBW goes outperform. They say that a sell-off related to the motor finance worries in that stock is overdone, and we're seeing a rebound thanks to that KBW upgrade. They're outperform on Lloyds, and Lloyds is up 1% this morning.
All right, Joe Easton from our Equities team, we thank you so much for walking us through all of the major movers that we are seeing this morning. Coming up on the program, we go back to the States. Disney CEO wins a vote of confidence. But does this mean the boardroom drama has had a fairy tale ending? We're going to bring you the story next. This is Bloomberg. Walt Disney shareholders have handed CEO Bob Iger a pretty big vote of confidence, rejecting dissident investor Nelson Peltz's bid for a board seat. Sources saying that Peltz won just 31% of the votes cast, the stock falling the most in more than 6 months after the results. Still up, however, 32% so far this year. Charlie Wells joined us this morning. He's all over the story. What do we need to know here?
I mean, look, this is the conclusion of one of the most expensive, one of the nastiest, one of the longest proxy campaigns in recent history. Disney spent big. They spent about $40 million treating this sort of like a political campaign. Peltz as well spent about $25 million trying to convince people that he should get on that board. And look, Iger lined up a lot of big names. He lined up Laurene Powell-Jobs. He lined up Jamie Dimon to come out in support of him. He also had to reach out to institutional investors as well as individual investors. So this is a big win for him, but a lot of his challenges aren't done yet.
Okay, so what are the challenges that he's still got to deal with? He's only got, a couple of years to deal with them?
Yeah, so look, he's got to go in 2026. At least that's what he said. He's previously said that before.
Yeah.
But Disney always has succession planning issues, and that's what Peltz was really focused on here. But one of the key things here also is streaming, right? So this is a company that is dealing with that difficult transition from linear to streaming. So they've really got to kind of change their content strategy. And look, they're saying that streaming, which has been incredibly expensive for them, could break even or hit profitability this year. Let's see if that happens or not.
In terms of spin-outs, for example, helping with that profitability story, Bob Iger was very vocal about them and then kind of quiet and then vocal again. Where are we on that?
I mean, there's been some questions that he's kind of tightening up, polishing up some of those assets. I mean, there's that linear TV asset. There's ESPN, of course. I mean, speaking about the difficulties of streaming, I mean, it's really difficult for consumers right now. And actually, Disney recently announced that they would be in a partnership with some competitors to try to bring this kind of sports streaming offer. And so a lot of questions. But look, Disney gets synergies, right? They've got parks, they've got movies, and let's not forget that parks bring in about 70% of Disney's profit. They get synergies when they've got content out there that's kind of advertising the parks and vice versa.
Okay, Charlie, great stuff. Thank you very much indeed. A whip through what the Disney story looks like. 101 Dalmatians. That's the Disney story from my childhood.
Oh, my gosh. In the commercial break, folks, I asked Guy Johnson what Disney princess came to mind. He came up with 101 Dalmatians.
There you go.
A lot of guys.
Well, it was a long time ago. The best movies of the 60s and 70s, I don't quite remember.
Was it in color? Was it in black and white?
Okay, now we're really pushing it. Alphabet could be about to introduce a paywall for its AI search function. We'll just talk about that story next. What does it tell us about the AI story? Where's Apple in this as well? We're going to figure that all out next. This is Bloomberg.
Us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
U.S. Treasury Secretary Janet Yellen, they're talking about what those tensions, geopolitical story, might actually look like. We've been hearing this time and time again from the Biden administration, trying to smooth some of the really tough rhetoric that they've been talking to from a domestic point of view.
Yep.
In the Xi Biden call, that was brought up, that President Xi has been watching what's being said in the States, especially ahead of this election cycle. And it's very kind of anti-Chinese rhetoric. And President Biden is trying to smooth that over, saying, look, we don't want to discourage investment. We don't want things to be bad. But
And it's the but that I think is important. Yellen getting on a plane. They're about to get on a plane, fly to China. She's going to be having meetings Friday, Saturday. I wonder whether she takes a more hawkish line on this. We are anticipating at some point soon that the US is going to reveal the latest round of tariff reviews. And the expectation is that they could be tightened even further. And this, ahead of what you say, is going to be a likely tightening or a more hawkish style of rhetoric going into the election.
Yeah. For me, this is also a devaluation story. I think a Treasury inflow story, a export story, as we talked about with the tariffs, but also a tech story at its core as well. Huawei, TikTok were points of the conversation between the two world leaders. Janet Yellen is uniquely positioned to talk about all of these issues as former Fed chair, current Treasury secretary, member of the Biden administration. She can kind of cover the gambit.
She is. She's also quite well trusted by the Chinese. The Chinese see her as potentially being more of an ally, and that's a relative term in terms of how they perceive her within the kind of the spectrum of hawks to doves on China in the United States. So I think that's interesting that maybe she's beginning to potentially shift more towards the hawkish side of the fence. It's interesting as well. I think you've got to see this from a European perspective too. You've got the European Union this morning kind of coming out and opening investigations into what's happening in the solar sector, what's happening in the green energy sector more broadly. The Europeans have got a very firm eye on what is happening with Chinese capacity right now. And if that capacity continues to be exported in the way that it is, then I think you're going to see action from Europe, action from the United States in the car sector, in the green tech sector, in a number of different areas. So it's not just the US that's taking a hard line. The Europeans look like they're pushing this one as well.
And I would argue even a harder line than the US is taking, to be honest.
Areas,
And there have been sanctions named. There have been specific companies targeted. There has been a Russia-China read-through question, even in terms of how the EU approaches India, for example. There has been plenty of tariffs, to your point, on the EV space as well. How do you protect competition here within Europe relative to the potential question of dumping coming out of China? At least that's the verbiage that's been used by a lot of leaders. The price war continues to be a topic as well for Europe, and in terms of, do the Chinese set the prices for the European continent? And the answer, I think, right now is yes.
Yeah, but the Chinese, how long will they be able to do that, I think, remains an open question. This takes us to the tech story, I think, quite interestingly, because at the core of so much of this is what is happening with the technology story, which takes us to the AI story, which takes us to what Apple and Alphabet are up to and the news that we've been learning over the last 24 hours. So Bloomberg has learned that Apple has been investigating a move into personal robotics. This is interesting because remember that NVIDIA presentation that we saw back a few days ago? Meanwhile, the FT is reporting that Google parent Alphabet is considering charging for web search features powered by AI. Let's talk about these stories in a little bit more detail. Mark Bergen joins us now on set. Let's start with the Alphabet story and figure out what is happening here. Much has been made of the fact that AI is going to be transformative, that it is going to change large areas of the economy, and that the Magnificent Seven, the big tech companies, are going to be some of the main beneficiaries of that. Does this story speak to maybe that actually that is going to be a struggle, that some of these big tech companies are going to struggle to maintain their leadership and maintain their profitability and margins as we make this transition?
Yeah, for sure. I mean, Google has the most to lose in many ways, right? They're the best position on AI. They have the most AI talent. They have probably arguably the largest data sets that they can exploit for AI. And then the ChatGPT and the generative AI explosion has posed the first actual serious threat to search in years. I think, from this news this morning that they're considering kind of a premium element to search, if I was an Alphabet shareholder, I'd be more concerned if they weren't considering that. I think for a long time, Google has been trying to get away from this dependence on web advertising, which is a shrinking market for privacy and regulatory reasons. I think that exploring ways to monetize AI and search outside of advertising is really interesting. That said, they've spent years trying to do that, and they're still basically an ads company.
Is the mindset at Alphabet more in terms of R&D and kind of innovation and developing some of the technology in-house, more kind of an M&A mindset to deal with the exact challenges that you're talking about?
Oh, they can't buy anything anymore. I mean, you have Brussels to thank for that. And D.C. as well. I mean, there's a lot of regulatory pressure. I don't know offhand the largest acquisition they've made recently, but they've been mostly on the cloud side, where Google's arguing, look, we're third place, we're distant third, we're not dominant market like in everything else. Fitbit was probably the most recent sort of consumer-facing acquisition, a big one. I don't think they don't have the political will and power right now to push forth anything on M&A.
These guys are spending a lot of money on chips, NVIDIA, all the kind of kit that they're buying right now. Are we certain that they can make money off that? are we certain that this investment is going to deliver a rate of return that is acceptable to shareholders?
Yeah, someone mentioned, really, I thought it was smart, that the company should be looking at not necessarily NVIDIA, but Intel, Samsung, TSMC, the ones that actually produce the fabs. And they're the ones that are measuring demand, and they're the ones that if the demand, this big hyped up demand around generative AI, and AI doesn't actually meet what people are talking about, then they're the ones in trouble. And from what I've seen, they think there's a skepticism that this can convert into just a massive business. I mean, OpenAI is a really good example. They seem to be having, from the numbers that have been reported, a pretty successful business on this. Yeah. The question is it going to look like the cloud computing wars, where there's basically 3 or 4 companies?
And it's commoditized in many ways.
Right. Or is there going to be one, like kind of in search?
It's interesting that you talk about Intel and the rest. Capacity seems to be a big issue. The catch-up seems to be a big issue right now when it comes to the chip story. Yes, there's the demand. Do we have the ability to make it all? In terms of making kind of AI a mass consumption product, does Alphabet have an advantage there relative to a Microsoft, relative to OpenAI itself, in terms of making your general mom and pop understand what AI is, make it a part of their daily lives, given the dominance that Google itself already has, and arguably YouTube as well?
Yeah, I think that's right. I mean, Google certainly has, I forget how many products they have, over 1 billion active users, right? They have Gmail, YouTube, Maps, all these are these huge repositories of data, proprietary data, and that's the big advantage.
But relative to to a Microsoft or an Apple, which are also huge data, consumer-facing companies,
totally.
Where does Alphabet stand in that?
Yeah, I mean, think about Apple's struggles with search. Think about Microsoft's struggles with search, right? Bing is having this kind of resurgence, but they're still well behind. And YouTube is this powerful video tool and repository that I don't think Google's really tapped quite yet on the AI front. I mean, they're just.
It's interesting. There's no obvious kind of competitors to that as well at the moment, which I think is kind of interesting too. Just briefly, let's just talk about Apple. Everybody's getting excited about robotics this morning. But what that tells me is that they're not getting excited about AI, and it feels like it's the AI story that maybe needs to develop and germinate a little bit more at Apple in order to give it the kind of the share price pop that it needs. I'm not sure. Are robotics going to be enough to get everybody excited about Apple again?
It's a great story that our colleague put out last night. I mean, I think AI. Apple has struggled. They haven't done anything big on the large language models front. Siri has been sort of this laggard for a long time. Robotics and home robotics is an AI story, right? In order for these robotics that people are talking about to really work and to do the things that people are, that plans and actually sort of, I read our story overnight, talked about being able to follow someone's face and identify someone speaking. That's an AI capability. And I think that Apple has
But do they provide the AI capability, or do they just provide the hardware, I guess is the question around that.
Yeah, that's a good question. I mean, if you look at the iPhones, they don't provide the search. Google provides the search. Yeah. So Apple can do partnerships. What they can do pretty well is design. And so something that Amazon sort of tripped up in this space around home robots, and that Roomba acquisition didn't go through. So, yeah, there's a question of does Apple need to do it themselves? I'm not sure.
What does the time frame look like on that, for example? The car project was a decade in the making, only to flop. Is there a time frame on what this might look like?
I mean, the home robots, I'll add this with caveat, as far as I know, they're not threatening people's lives, hopefully. Cars are a big, messy, and talk to anyone in Detroit, they're big, messy supply chains, and they're massively regulatory problems, right? One of the major hurdles for self-driving cars has been getting it perfect. And I think they're not going to face that same issue with something like a home robot.
Yeah, Tesla, you can certainly see that.
But I will make no predictions on timing.
We've been talking about robots for a long time. Even back in the 1970s, the cartoons, maybe a little bit more focused on that as well. Mark, nice to see you. Mark Bergen joining us on the latest story out of the AI story, which kind of is dwelling in so many areas at the moment. Just not everybody maybe getting the same benefit. Coming up, you don't want to miss our exclusive interview. Brad Lightcat, the COO of OpenAI, is going to be joining Bloomberg at 4:30 p.m. London time. Looking forward to that conversation as well. The next thing we need to talk about is what is happening with this NATO 75th anniversary. Yeah. This is a spending story as well. It's an AI story too. It's all kinds of different facets around this. How does Europe spend money correctly? AI is going to be part of the defense story, which is why everybody's so kind of hyped up about the security implications around all of this. How does Europe rearm in the correct way and maintain its other budgets as well? I think it's a huge challenge.
It is. I think we talked about timeline for the tech story, timeline for the defense story. This stuff takes a lot of time, and how do you plan around that? This isn't just about getting contributions. This is about, okay, well, what happens when you get the financing? Is this years in the making? Is this factories that need to be developed? Is this partnering with international defense companies, not just European companies or European defense companies? And something tells me that even though it might be less fiscal spending from the States, your Boeings, your Lockheed Martin are still going to see plenty of demand, this time coming from European customers instead of American.
There is a huge push in Europe maybe to develop a more domestically orientated supply chain story, which I think is something that Europe has long looked for, but has never had the coordination between the various nations to make that happen. And therefore, the economies of scale have, as you say, centred around Boeing, around Lockheed Martin. And you've seen European defence companies like BAE Systems going to the States maybe to kind of take advantage of that supply story as well.
And one area that we haven't talked, we talked about it from a defence stock perspective, from an investing perspective, fiscal perspective, is the raw materials story as well, right? Okay, so you do secure the financing whenever that happens. You build out the material, the factories, whatever. You build out, you get your talent pool, your engineers, et cetera. Everyone's on the same page. Where does that come out? That's a boost to commodity demand.
Yeah, particularly raw materials, rare earths, those kinds of things.
Yeah.
Where do they come from?
Exactly.
China.
And that's almost folds it together, right? That NATO is actually talking about relationships in the Indo-Pacific.
Yeah, but it also takes you down the road that Europe has got much more to figure out simply than just the financing, to your point. Figuring out from the supply chain, from the mine to the kind of the munitions in the hands of the soldiers, I think is a huge kind of. It is a huge supply chain that's still got to be figured out and done so in a more coordinated way.
I'm so curious about the timeline in this and what that story actually looks like. Lucky for us, we got the perfect guest to talk about it with us. Coming up on the program, we speak to Fabrice Pothier, CEO of Rasmussen Global, on European defense and NATO as the alliance marks 75 years today. That conversation next. This is Bloomberg.
Welcome back. You're watching Markets Today. We are 46 minutes into the equity session. As you can see, generally green on the screen. That's what we're watching today. European markets, though, I think probably are waiting for the claims data out of the United States. And then we are obviously going to get the payroll number out of the States tomorrow. Yesterday, the tone set by the ISM and to a certain extent Powell. I'm not actually sure kind of which had the bigger effect yesterday, but certainly those two events in the States significant yesterday. A lot of Fed speak through today. The other event that we're watching so carefully here in Europe, NATO foreign ministers meeting in Brussels today. The alliance marking its 75th anniversary. Secretary General Jens Stoltenberg will be speaking later this morning, 9 a.m. UK time. Here's what he had to say on NATO providing support for Ukraine.
We are transforming NATO's comprehensive assistance package into a multi-year program of assistance. We are helping Ukraine move closer to NATO standards on everything from procurement or logistics. And we are supporting Ukraine's reform efforts to bring Ukraine ever closer to the alliance.
75 years of NATO, it's worth reflecting on that, but maybe the bigger question is where does NATO go from here, and what does the expansion in NATO ultimately look like? We've taken in new countries over the last few months. Does that continue, and is Ukraine next on the list? Fabrice Pothier, Rasmussen Global CEO and former NATO Director of Policy Planning, joins us now. Fabrice, good morning. The Secretary General there talking about the idea that NATO is bringing Ukraine closer and closer. Geographically, obviously, it has been on the front line, but increasingly it feels like it's included within NATO. It's using NATO standard kit. Its communications are being integrated. Is the next logical step for NATO to include Ukraine within its borders, and how big a risk would that be?
Well, I think that's the key question, frankly. And even though we should welcome NATO putting more money, more support on the table, and moving from a backstage to a front stage role, which was until now very much the EU and obviously the US and some big member states. So this is welcome, but it doesn't change the fundamental question is when will Ukraine join the alliance? Because this is the real game changer for both European security, but also to start ending this war on terms that are positive terms for Ukraine and for us.
If we put Ukraine in NATO, it raises the risk for NATO. this is a common defense umbrella, and we're not going to change the architecture of that. If we include Ukraine, the risk of war has to increase. Is NATO, is the rest of Europe in particular, really prepared to fund NATO to the point at which it's capable of bearing that risk?
I think this is the tune you hear very much, sadly, in Berlin and Washington. But the reality is a bit starker in the sense that the dilemma we face is: do we deter Russia with a weak Ukraine and a Ukraine that is occupied and possibly critically undermined by Russia? Or do we deter Russia with Ukraine strong and independent enough and member of the alliance? And I think from a pure cost and also from a risk point of view, the second option is much more appealing than the first one, where the risk of war will still be there. It will actually be Russia at our border rather than at Ukraine's border. And the resources we will have to dedicate to deter a successful Russia and Ukraine will be much greater than those we'll have to dedicate to bring Ukraine inside the alliance. And don't forget, Ukraine is now actually one of the prime military powers in Europe. So it's not like if they will just bring problems, they will also bring capabilities and solutions.
Well, in terms of those capabilities and solutions, there's a lot of questions here that if somehow the financing is actually secured, what does this capacity buildup, this European defense buildup, look like? Fabrice, walk us through a potential timeline here of Europe making up the gap.
Well, first, I think we have to put this 100 billion euro fund into a broader context. We have roughly spent a bit more than 100 billion euro in just 2 years, both between the US or North America, if you want, and Europe. So 100 billion euro over 5 years is substantial, but it's not dramatically changing the picture. I think it's a way to try to reduce some of the risks that the election of Donald Trump might create, but it's not going to solve it all. And countries, member states, will still have to contribute bilaterally enough for Ukraine to have the kind of capabilities, the kind of weapons, the kind of ammunitions they need to be able to hold the line. But quite frankly, I think this war will end, and will end on terms that are good for Ukraine and for us, only when Ukraine will have this complete guarantee that it will never happen again. This is when possibly the Ukrainian leadership will have the strength to make some possible compromise and to explain those compromises to the population. But if they don't have this guarantee that they will join the alliance, that they are part of the alliance, why would they make any compromise? Yeah. They better keep on fighting.
But being a part of that alliance requires spending as well. To your point, the NATO itself needs that European contribution. What does, you mentioned Donald Trump and the potential re-election. What does Trump-proofing NATO actually look like? How realistic of a possibility is that?
It looks like a difficult exercise, to be honest. I think there are things we, the Europeans, can do better, starting with spending more at home, putting more resources towards Ukraine, multilaterally, bilaterally. But fundamentally, you need the United States because of the range of weapon systems available and produced in the United States, the political leadership that the United States bring to both NATO and to Ukraine, where then you will be down to what we have been seeing for the past few months, where you see very difficult European leadership and very tense leadership, I would say, between France, Germany, and to an extent Poland. And without the United States, it's very difficult to find a unity point about how the alliance can go about helping Ukraine.
Okay, let's broaden the lens and think about
compensate.
True. Let's talk a little bit about how Europe deals with this and the choices that Europe has got to make. In the scenario that you're talking about, let's say Ukraine is included, the risk rises. Maybe the risk doesn't rise, but the overall risk rises. We either leave Ukraine out and there's a risk, we put Ukraine in, there's a risk. Europe is going to have to spend some more money, Fabrice, on defence.
Absolutely.
And it's going to make sure, and it's going to need to spend that money over a long period of time. Defence companies are not going to step up and increase capacity if they think that European leaders are going to wish for a peace dividend 2 or 3 years down the road when maybe some of these challenges have gone away. How does Europe rearm? What difficult choices are we going to have to make? And do you think it ultimately is going to come down to maybe carving out defence budgets differently in the way that rules are made? Is it going to be making decisions about whether or not we spend weapons or welfare? There's going to be some really difficult decisions coming up. Do you think European leaders are capable of making them?
Well, you are spot on. I think first it requires a change of mindset from a peacetime, peace dividend mindset to a pre-war time, and to accept that now war is a possible prospect, and therefore we have to prepare for it. And this is where you will have to make some fiscal choices. That you are right, there will be some difficult trade-off between social security, welfare, but also our own security, physical security. And this is where I think European leaders have to be more forthcoming, and not just, Macron and a few other ones, but all of them together. So that's one thing. Second, I think you need to see, obviously, an increase in the resources allocated to defense. We're still facing roughly a €100 billion gap in European defense spending. And I think Germany and others, and Spain and Italy, the kind of middle class of European military powers, need to go much further and to rebuild some of the capabilities they have lost. And then finally, I think here in Brussels, the European Union can play a much more active role, provided the member states agree to resource that, can play a much more active role in trying to find savings, to find multinational common projects, so that we can build the capabilities that Europe is really missing, mostly in air defense, in strategic surveillance and reconnaissance, where we really need to beef up our technology and the number of systems we have.
Fabrice, great to catch up. Thanks very much indeed for spending some time with us this morning.
Thank you very much.
Fabrice Pothier, Rasmussen Global CEO, former NATO Director of Policy Planning. While we've been speaking to Fabrice, some data coming out of Europe. France March services PMI 48.3. The preliminary number was 47.8, so that's an improvement. The comp number goes up to 48.3 versus 47.7. Germany, the services PMI goes to 50.1 versus a preliminary 49.8, so a pick up there. That takes the comp number 3 points higher as well.
I take no responsibility for France and Germany at all.
I give you time. We'll
but
look at what's happening with the euro. The euro is spiking higher on this data.
But I think that German data is the one that they're probably reacting to the more, right? Because the last couple of data prints have been quite weak on the German front, where we have seen outperformance in Spain, Italy, and France as well. Speaking of data, we've got plenty more to watch out for in today's session. 9 a.m. UK time, we've got Euro area services PMI final data is due to be released, and at 1:30 p.m. the spotlight shifts to the U.S. Trade balances data and jobless claims coming out of there. Plus, of course, multiple Fed speakers throughout the day. Harker, Barkin, Goolsbee, Mester, and, of course, Kashkari, who's not a voting member. And we're going to keep an eye on those NATO meetings. They continue in their second day, marking their 75th anniversary. A lot to digest in the shows ahead. You are still going.
I'm still going. So yesterday, Kriti carried on with the pulse. Today, it's my turn. Eric Nielsen's going to be joining us. Looking forward to his take on what is happening with the European and global economy. We're going to do fiscal. We're going to do monetary. That is all coming up. This is what European markets look like. The pulse is next. This is Bloomberg.